Right, I wanted to look at ROCE, operating margin, and asset turnover and how they all fit together. So, operating margin, like any margin, it's whatever it is divided by sales. So, an operating margin is operating profit divided by sales. Gross profit margin would be gross profit divided by sales. So, any margin is always divided by sales. Asset turnover, on the other hand, is, well, how well are you using your assets, which is all the capital you've employed, to make the sales? So, how hard is your capital working to make sales? How much are you sweating your assets? How much turnover is made by your assets? Now, if operating profit is operating profit divided by sales and asset turnover is sales divided by capital employed, you could cancel out the sales and get yourself a whole new ratio that is related to itself. So operating profit divided by capital employed is actually the return on capital employed. So the return on capital employed is actually just a mixture of the operating margin and the asset turnover. Let me explain further. So once we know those three ratios, I can tell you that if operating profit is 5% and asset turnover is 2 times, so you've made twice the sales as you have your capital employed, as you have your assets, then 5% and 2, ROCE is explained by operating margin and asset turnover, so ROCE must be 10%, 5 times 2. They are literally explanations. The ROCE is explained by the operating margin and the asset turnover. Similarly, if ROCE was 12%, it's explained by the asset turnover maybe being 3, and therefore, what would the operating margin, what must it be? 4%. So what we're saying is, ROCE can be explained by the operating margin and the asset turnover. So in your exams, you can talk about these individually, but when you come to talk about ROCE, just say, look, the whole thing about ROCE is it's partly the operating margin that's caused its gain or fall. It's partly the asset turnover that's caused its gain or fall.